Most people think of an investment losing money as just a bad thing. But for Canadian investors who know what they're doing, a losing position can actually be turned into a tax advantage, one that puts real money back in your pocket. It's called tax loss harvesting. It's completely legal, it's underused by most Canadian investors, and once you understand how it works, you'll never look at a down position the same way again. Let's break it down. Before we get into the strategy, a quick refresher on how investment taxes work in Canada. When you sell an investment for more than you paid for it, you have a capital gain. In Canada, 50% of that gain is added to your taxable income for the year, meaning if you made $10,000 in capital gains, $5,000 gets taxed at your marginal rate. If you're in a 40% bracket, that's a $2,000 tax bill. This only applies to investments held in non-registered accounts. Inside your TFSA or RRSP, capital gains are completely sheltered, which is why, as mentioned in a previous video, those accounts should always be your first priority. But for money invested outside registered accounts, capital gains tax is a real cost, and tax loss harvesting is how you legally reduce it. Tax loss harvesting is the practice of selling an investment that has dropped in value to realize a capital loss, and then using that loss to offset capital gains elsewhere in your portfolio. Here's a simple example. Say you have two investments in your non-registered account. Investment A has gained $8,000 this year, and you want to sell it. Normally, you'd owe tax on that $8,000 gain. But investment B has dropped by $5,000, and you're not particularly attached to it. If you sell investment B before year-end and realize that $5,000 loss, it offsets $5,000 of your gain, meaning you only owe tax on $3,000 instead of $8,000. Capital losses can also be carried back 3 years or carried forward indefinitely. So if you have a bad year with no gains to offset, you can bank those losses and use them against future gains. This is completely above board. The CRA explicitly allows it. The key is understanding the one rule you absolutely cannot break. The CRA has one major rule around tax loss harvesting called the superficial loss rule. It works like this. If you sell an investment at a loss and then buy the same or an identical investment within 30 days, either before or after the sale, the CRA disallows the loss. You don't get the tax benefit. This catches a lot of people who sell a losing ETF, immediately buy it back, and assume they've harvested the loss. They haven't. The solution is to swap into a similar but not identical investment during that 30-day window. For example, if you sell XIC, which tracks the Canadian stock market, you could buy VCN, which tracks a very similar index. Your market exposure stays roughly the same, but because the two ETFs are not identical, the superficial loss rule doesn't apply. After 30 days, you can switch back if you want to, or just stay in the new ETF. Either works. Tax loss harvesting only applies to non-registered accounts, only matters when you have capital gains to offset, and requires care around the superficial loss rule. For most beginners whose investments are entirely inside a TFSA, it's not relevant yet. But as your portfolio grows and you start investing in non-registered accounts, this is a tool worth knowing. Year-end, November and December, is the best time to review your non-registered portfolio for loss harvesting opportunities before the calendar resets. Next week, we're covering GICs, what they are, when they make sense as part of a Canadian portfolio, and when they don't. If you've seen the high GIC rates offered by Canadian banks lately and wondered whether you should be using them, next week's video is for you. Subscribe, and I'll see you there. See you then.